Hey, everybody, and welcome back to the show. I'm so excited to introduce our guest, Bill Ham, to the show. Bill's got a great story. We can't wait to share it with you. Bill, welcome to the show.
Thanks for having me.
Awesome. So, everybody, Bill's got 16 years in the real estate business. He has built a portfolio of over 1,000 units and has built a property management company. He's also author of the best-selling book, Creative Cash. Awesome, Bill. So, why don't you take us back in time and give us a little bit of color as to how you started out in your career and how you got into real estate?
Sure. I was a pilot by trade, flying as corporate aviation. I had graduated college and started flying airplanes, and then realized that I loved flying airplanes. I just didn't like being told when and where to do it, which is kind of the definition of a job. And I just got sick of that. So I started watching friends of mine. This is back in 2005, 2004, 2005. I saw friends of mine flipping houses and doing real estate, and they were making more money than I was making working all day. And I thought, well, there's nothing special about my friends. And so if they can do it, I can do it. And I went out and I studied for a little while and read books. And my very first real estate deal was a duplex. It was cash flowing about $300 a month. I'd saved up $10,000, my total life savings, and walked away from the aviation career. Just went into real estate full time with a duplex and $300 a month. I don't recommend everybody go do that, mind you, but that was my path. It was the right move for me. Of course, I was younger. Again, I was 28 years old, so it was a little easier for me to do it.
Yeah, that's very gutsy. I definitely will say. Back then in 2008 or whatever it was, where were you learning about real estate back then?
Yeah, well, back then, it was more books. There weren't as many. There really was not the available resources that there are today. There was the age-old classics, Rich Dad, Poor Dad. Some of these things. I started with some of those. Some of my first real estate education was still on a VCR that I had to slide in on the VCR tape that I bought. It was at a garage sale. So that's how I got started. Just really whatever I could find, books and what garbage information I could put together. But Carlton Sheets. You're probably too young, but Carlton Sheets is one of my first real estate programs, and that's old school right there. So if anybody knows who that is, that's on back there. But so I got started. Yeah. Mm-hmm.
That's very interesting. I remember starting back in 2010, and I remember listening to a lot of books, but podcasts were really not a thing in 2010.
Correct.
Yeah.
Right.
So for folks listening out there, just know that you have a lot of free information, free educational resources at your fingertips. So anyway, so Bill, so you bought a duplex, and then how did you buy a duplex with $10,000, and where was it? Tell us about that deal.
Well, this deal, as well as the first 402 units that I ever closed, were all creative financing of some sort. So did not involve traditional loans or traditional mortgages or banks or things of this nature. So it was all seller financing and lease options and different types of debt strategies, credit cards. I don't recommend that one. But all different types of financing. And that's how I got started. So the duplex, the very first deal, actually seller financing from a friend of mine. So that's how I got into that first one. And then I was able to refinance sometime later at a bank, paying off the original seller financing. And that's how I kind of got into the loan. But a lot of seller financing, lease options, things like that early on.
Okay. So for our benefit, when you refinanced that duplex, how did that refinance go? Did you need to prove income? Was it just income from the property? Did you have to have personal assets? How did that go?
Yeah, number one, it was a little bit easier back then. Loans have tightened up since back then. But largely once you own the asset, refinancing it is a function of the property value, really. As long as the value goes up and you bought it at the right price, then refinancing it and paying off that original debt is not that difficult. Now, when I say refinance, I wasn't refinancing and pulling out a lot of cash. I was just refinancing to pay off however I got into the deal in the first place. if it was a hard money loan, or if it was a line of credit or seller financing or something of that nature. I use that function to get in and then refi and pay off that short-term debt.
Okay, awesome. So, you wrote a book on creative cash, and as you just mentioned, you used the same strategy back then to purchase a duplex that you just used to purchase 402 units. And I know you've sort of climbed up the food chain, so to speak, in real estate. And it seems like you've been using creative financing most of the way. Is that true?
It is. I've done creative financing in different aspects throughout my career, certain deals here and there. It was much more prevalent back post last recession and in my earlier career. And then I kind of moved into syndicating larger commercial properties of larger multifamily assets. So I ultimately kind of moved up the ladder and was not doing so many of the smaller creative financing deals, but I have done some larger creative financing as well. Seller financing on a 152 unit complex, master lease option on a 108 unit, and some seller carryback on a few other deals. But yeah, so that's kind of the progression as I moved up the ladder. Seller financing, or creative financing in general, let me say that, it can be very market specific. When people don't have problems, creative financing is not that common. Okay, meaning over the last 5-6 years, the market has been so good that most sellers haven't had problems. So you haven't really seen a lot of that creativity in that aspect. Creative financing gets really ramped up when assets become distressed for whatever reason, repairs, maintenance, occupancy, things like this. But the lenders aren't right there with that easy money, and they start pulling back. That's when you can use creative financing to bridge that gap. Here's a seller, they have a problem. The property won't appraise, its operations are bad, whatever the case. Your lender doesn't want to give you a very decent loan. How do you close the deal? Seller financing, lease options, other manners. So it's a very specific technique, and you use it in very specific instances.
Okay, awesome. So, clearly everyone should go get your book and read about it. But for our listeners who aren't familiar with some of those creative financing options, can you give us a brief overview of what you mean by seller financing and lease option?
Yeah, seller financing is basically exactly like it sounds. The seller is going to act as the lender. So first carve out there, the seller cannot have a mortgage, right? The seller has to own the property free and clear for them to finance it to you, or either the down payment money that you give them has to pay off their primary mortgage. So they can't really give you a loan if they have a loan, not legitimately. There are some things people do called subject to and wraps. I won't get into that, but I think that's relatively illegitimate financing. So a seller has to have 100% equity to give you financing, right? And then you may put down a little bit of down payment, just like you would with a bank. You pick an interest rate and an amount of time, and they hold a lien on the property just like a bank would, but the title transfers to you. Seller financing. Lease options or master lease options, a little more complicated there. That's sort of a rent to own. So if we're talking about one house, it's just a rent to own or a lease option or a lease to purchase. A lot of people are kind of familiar with that. When we talk about multiple units like apartments, we add this word master in there, but that's all. It just means covering more than one unit. It's a rent to own model. So I'm gonna rent a property from you with the right to two things, right? To sublet the units to the tenants. So now I'm effectively acting as the owner, in function. And then I have the right to buy this property for a price that we're going to negotiate today, but I'm going to have a certain amount of time into the future in which to buy the property, maybe 1, 2, 3 years in the future. So you and I would pick a price today, $1 million. Fine, I've got 3 years in which to buy your property for $1 million. In the meantime, I get to operate it. So that's the lease option. The master lease lets us rent, and the option to purchase gives us the right to buy the property. Why would you do that? Well, you want to go in and do that on a distressed asset that you can bring the value up above that option price. So again, if we agree on $1 million price and I can make the property worth $3 million, then I still get to buy it at $1 million. So that's why we would do that. That's roughly a master lease option. Again, we could spend an afternoon just discussing that one topic, but that's a 10,000-foot view of it.
Yeah, for sure. And just one question before we move on. So then does a person have to pay rent or anything like that to the seller
They
during
would.
the, okay.
Yes, they would. It's negotiable, but the standard rent payment would be the mortgage. You know, if they have, and by the way, if there's no mortgage, do seller financing. If there is a mortgage, do a lease option, right? So you would want to cover their mortgage, taxes, and insurance. Hopefully, you don't have to cover any more than that, meaning any of the positive cash flow you get to keep. Sometimes, depending, we may need to share a little of that cash flow with the seller, just depending on the deal. But that's kind of the idea, is that your rent payment makes the seller break even. So
Okay.
you're covering their mortgage, taxes, and insurance.
And that's something you would do in it for a distressed property.
Correct. Yeah, a distressed property or a distressed seller. See,
Mhm.
people forget that real estate is 10% the asset, 90% the seller.
Mhm.
So you've got to have a seller that's willing to do whatever for this deal to work. And so who knows, maybe the real estate's in great shape, but maybe the seller has some personal problem. They're burned out. They don't want to deal with property management. They don't want to deal with tenants. You know, who knows? And they want out of the deal. And the only thing they know to do is sell it. But for whatever reason, they can't get the price they want because the asset's distressed. This is where you come in and you can get them the price as long as they lend you the property and let you go in there and do the work, the repairs, the maintenance, whatever the case, and bring the value up.
Awesome. Okay, great. So let's talk about, a little bit about your journey. So you bought that duplex, and what'd you do after that?
Bought some more, bought another one, and bought a few more after that. It just went to work.
Yeah.
Just kept, I had figured out what worked for me as far as a deal, my analysis, the math, all that sort of stuff. So then really it's the same for any real estate investor. It's deal flow. You just got to go look at more deals, because most deals are not good deals. And so you have to look at a lot of them to find the few that work. So it was really just a rinse and repeat model after that. Just look at more deals, do more business.
Awesome. Okay. And then, obviously you were saying after the recession, you started transitioning more towards syndications. Let's talk
Correct.
about why you decided to make that transition. I mean, it, may seem sort of obvious to some of us who've been in the business for a while, but for people who, are just getting started and, kind of can wrap their minds more easily around these smaller duplexes, flips, et cetera, why did you start moving towards syndications?
More commas, more zeros. It's just more money. Number one, real estate is a very difficult business to grow and scale without partners. Yes, it makes sense. Go do a house, go do a duplex. You can probably do it all by yourself, and that's great. And you keep 100% of the profit, 100% of the deal. Wonderful. But it's going to take you a lot of years of houses and duplexes and small properties to finally build up a portfolio that makes money, or makes any kind of retirement type money. If you are willing to accept partners and investors, you can move up the size of the asset that you're doing much quicker. So if you want to go buy a duplex, a bank they're going to look at you, they're going to look at how much money you make a month, your W-2, this kind of stuff. If you want to go buy a 100-unit apartment complex, they're going to look at the asset to see if the asset makes financial sense, if the asset makes money. They're going to largely be lending on the operations of the property, but they're going to need you to have the net worth equal to or greater than the loan amount in most cases. So when you want to all of a sudden go from a duplex to a 100-unit apartment complex, you may not have the net worth to satisfy the bank. That's why we bring partners in. That's why we syndicate.
Okay, great.
It's one of the reasons. There's lots, but that's
Yeah. Well, yeah. So what was your first partner that you brought in when you wanted to do a deal that you just weren't quite big enough to do?
Yeah, actually, it was one of my first larger commercial properties. It was 152 units at the time, and I had a friend of mine who is also in multifamily, and I knew had a lot more net worth and experience than I did. And I wanted to do this 152 unit apartment complex, which I knew was a good deal, mathematically, but I didn't have the financial wherewithal to take that deal down. And so I went to him and said, hey, look, you and I get together and do this deal together. And then we went out and raised money from investors. And that's what we used as the down payment money. So that was my first syndicated deal.
Okay, great. And is this like, how does this real estate, I mean, clearly you do real estate, you abandoned your pilot career pretty early on. um,
Yeah.
what do you love about real estate? Why do you like to stay in real estate?
I like business in general. To me, real estate is a product. It's not that I'm married to real estate specifically, is that I like being an entrepreneur and I like being business. Real estate allows for leverage. And that's one of the big reasons that I like real estate as a product is because you can use lender debt to go out and buy these assets without having to have 100% of the cash. A lot of other investment models really require a lot more liquidity, don't have the ability for you to use other people's money as readily. And so it's just the barrier to entry is a lot higher in a lot of other businesses where you just have to be very cash heavy to get started.
Yeah, for sure. It sounds like you have a pretty classic and story of starting small and just continually growing,
Right.
which, not a lot of people actually end up successfully executing on. So,
Agreed.
to what do you attribute your success and your growth?
The understanding of market cycles. That's probably it's a complicated answer, but that's the big one. Most people survive in real estate about 6, 7 years, and they get wiped out. And that's because they make a whole lot of money when everybody makes a whole lot of money, and then when the market turns down, they lose it all because they didn't understand the shift in markets, and they kept doing the exact same thing until they couldn't do it anymore, and then they failed. And so my success has been from understanding the shifts in markets, the rise and fall, and knowing how to adjust my strategy accordingly. It's like if you want to flip houses, that's fine until the prices fall apart, and then flipping no longer works. And so you're in the business and now you're out of the business. Well, I found that's what, look around and ask anybody that's in multifamily, not houses, but that's in multifamily commercial real estate, how long you been in the business? It's rare to find somebody that went through that last recession that's still here. Most have only been in this business last 5, 6 years at most. Well, all you've seen is a good market. All you've seen is the upside. You've never seen a recession. You've never seen a real recession. You've never seen the downside. You've never seen a market go the other direction. So you're untested. And we're about to have a market shift, and as soon as we do, most of those people are wiped out. Most.
Hmm. For sure. Yeah. So what do you think happened to those? I mean, my understanding of the last recession, 2008, 2011, et cetera, was that multifamily weathered the storm better than other,
It did.
flipping and single family home markets. So, but yeah, I mean, obviously a lot of people started doing multifamily post that time period.
Right.
So, in your experience, do you really not know any people who were investing in multifamily before then?
Let me see. I could about like that.
So you think they all got wiped out?
Yeah, most of them. Not all, not everybody, obviously,
Sure.
but yeah, a lot. Yeah.
Yeah. Okay.
I'm just saying, go find somebody that's been in the business 10 years.
Yeah. Yeah, it is.
Rare.
It is challenging, I would say. Most people that I know, started anyways, but you were in it before. So how did you weather that storm?
I luck. Luck. I got started in '05. And so I was really kind of doing a lot of houses and a lot of smaller assets.
Mhm.
And I didn't over leverage. And so kind of going into that recession, I didn't own as much real estate, I think, as everybody else did. So I was able really to go in and pick up a lot of the foreclosures and a lot of the pieces. And I built my portfolio out of that sort of recession cycle, whereas I was not heavily invested sort of prior to that cycle. So that's why I kind of say it was luck. But since then, I've learned what mistakes did I make and what mistakes did everyone else make. And I've paid attention to those market cycles. And now I know how to look at a market and tell what's coming and what are the indicators that we may be in for this or that type of market,
For sure.
So that's just luck and experience.
Yeah, totally. So what are you doing to prepare? What lessons did you learn for this next market turn in the market?
I have learned the fundamentals of underwriting, the fundamentals of analyzing a deal, and the fundamentals of knowing when you're not adjusting for risk, when you're taking too much risk. And that's what I see in a lot of the market right now is way too much risk taking.
Mhm.
way too much. And the fundamentals are loose in a lot of those cases, which typically means when you see that, you'll start to see debt tightening up. You'll start seeing lenders tightening up on criteria, things of this nature. When you see that, they stop funding those distressed assets. And when you see that, you start using creative financing, which is why I brought the book out when I brought it out, because I am predicting a downturn over the next year to 2 years, and it's going to be for a few years there. Not a crash like '08, I'm not saying that, but a correction. And I think debt is going to lead that correction. And when they do, distressed assets are hard to sell. That's where there's going to be a tremendous amount of opportunity for people that learn these techniques.
Okay, interesting. So what would you say some of the fundamentals, the underwriting fundamentals, people start being more risky? What are some of those risks that you see people taking?
Rent growth and interest only. Those are probably the two biggies right now. What I see people doing is trying to justify overpaying for an asset by raising rents. Basically the buyer says, hey, this deal sucks, but that's okay because I'll raise the rents a whole lot and then the deal won't suck. That's risky. You know what I mean? So basically you're saying, hey, if the rent doesn't continue to go up, this isn't a very good deal. And you're okay with that. That's risky. You know what I mean? You're saying this is not a good purchase. This is an opportunity. I'm going to go ahead and reward the seller with a ton of future profit, but that's okay because I'll just impoverish the tenants a lot more. And then my deal will make a lot of money. Careful with that one. Yes, rents are going up and they have continued to go up, but they won't forever. Number one. Number two, if we see inflation coming up in the market, you don't want your renters to say, do I buy food or do I pay rent? Do I pay gas or do I pay the new rent? See, because when all of a sudden we have a lot of inflation, everything else gets expensive faster than job growth keeps up with for a little while. So if all of a sudden, milk and eggs and food and all the things and the cost of grocery store we're seeing right now all jump up in pricing, that competes with your renter's affordability to pay the rent. And that's what I'm saying. Watch inflation. If you see inflation going up, it's going to, in my opinion, it's going to be tougher to kind of charge more and more and more in rent until the job growth and the wage growth catches up with it. And it's always slower. So you're going to see, inflation kick up highly, and then eventually wage growth catches up with it. But in the short term, that can really impoverish a lot of people. And that's what I'm saying. Be careful about buying real estate and expecting the tenants to save you if you overpay. That's a mistake. And the other one that I see as a big one is people, the misuse of interest only. Hey, this deal doesn't really make money, but if I get interest only, then it makes money. No, see, that's a misunderstanding of debt and interest in loan terms. You're yourself in trouble with that one. And I see that a lot. Basically people's underwriting says this deal works. And then when the interest only window runs out, let's say they get 2 years out of a 5-year loan, 2 years are interest only. And they say, well, gosh, the 2-year window, the deal looks good. And then after 2 years, the deal looks terrible. So we'll just refinance in 2 years and get all of our money back and just get interest only forever. Yeah, no, you're not. And that's also another area that I see people making huge mistakes. It's what I'm from Georgia. And good old rednecks, what I call pencil whipping. Just pencil whipping those deals. You're making it look good on paper. You know what I mean? But in reality, is that really going to come to fruition? And that's what we always joke. We say, these kids are pencil whipping those deals. And I think that's what's going on. A lot of people are being very aggressive on paper. And what they're going to find is when they go out to truly operate those properties, they're not going to come to what they had on that piece of paper.
For sure. Yeah. I mean, there's no question that multifamily has been, at least especially multifamily has been quite overheated for a while. And, even it seems to still be, pre-pandemic kind of pricing. So, but I'm curious, I want to just touch on a couple of things that you mentioned there with the rent growth. Do you have like a sort of general rule of thumb? I mean, obviously it's going to be different depending on the market, but maybe some markets that you're looking in, what sort of rent growth assumptions would you say are conservative and fair?
Yeah, I would always kind of peg your rent growth to the national average, and we've seen a lot of rent growth over the last couple of years. We have, but I would really look heavily at the national average and see how much above that are you trying to get, and that's what I look at. And so I would say for right now, zero rent growth to maybe 3% in your underwriting to be conservative. Another major thing you got to pay attention to, and I see this one here's if we're going to pull out mistakes. Another major mistake I see is that someone will be looking at a property where a large percentage of the tenants are not paying rent because of the rent moratorium. And they say, well, here's 20% of your tenants that aren't paying rent, but the rents are below market and we should raise the rents. Really? On which one of the tenants? The tenant that owes $3,000? Or maybe you should raise the rent on the tenant that owes $5,000. No, raise the rent on the tenant that owes $10,000. That's a good idea. Come on. I mean, it's like, stop and think just a little bit. You know what I'm saying? And the realtors over there going, no, the rents are below market. The rents are below market. No, they're not. If the tenants aren't even paying rent, they're not below market. And, newsflash, that's high school economics. That how this works. You know what I mean? And so I see a lot of that kind of stuff where tenants aren't paying rent. There's some kind of issue with the property and they're going, oh, but the rents are below market. Well, look, if the rents are below market, go raise them. Don't renovate the property. Don't spend money. Just raise the rents. Why do you have to go in there and put in granite countertops and new lights and this, that, and the other to raise rents? If the rent's really below market, just raise the rent. Don't do anything. If you've got to bring the product up and create a new product in order to raise rent, the rent was not below market. You're creating a brand new product. You're renovating the unit. That's not how that works.
Yeah, for sure. Totally. Okay. And so for interest only, what would you say like a fair way to underwrite or a reasonable conservative way to underwrite the interest only period is? Like, what would you do afterwards? Like make sure that the loan rate is
the deal needs to be able to cash flow outside of an interest only window, not only inside of it. And that's like, so in your underwriting, the interest only window, you should have double cash flow. And then when you come outside of that interest only window, you go to good cash flow, and most people get okay cash flow because they're in this interest only window and basically no cash flow unless they raise the rents a whole lot outside of the cash flow. And that's what I'm saying. That's just not a risk adjusted return. People are trading real estate like they're stocks. Well, when real estate stops trading in a few month ownership window, someone has to operate this thing. Somebody's got to go be a landlord. And I think that's where there's going to be a lot of fair weather investors get called to the carpet when all the speculation stops and you realize you just GameStopped a bunch of real estate. It's not going to work out for you.
Yeah.
My opinion.
So then
one man's opinion.
If you're conservatively underwriting, compared to everyone else, how are you winning deals?
I'm not.
Okay.
I'm not doing very many deals right now. And that's the one thing, and I love the question because people always say that, oh, I'm being very conservative. I'm conservative. Really? How many deals are you doing? Oh, we're doing a deal a week. You ain't being conservative. Get out of here. You know what I mean? I've done one deal over the last year and a half. Most of my offers won't be accepted. Yeah, because I have a baseline that I stick to. And when the market rises above the baseline, the market leaves me behind. I'm good. Hey, I've been here a long time. I'll be here. You guys go ahead, run right on ahead and all that leverage and get that interest only. Go right ahead. I'll see you on the other side. Because I've been here. I'll be here. I know how to clean up a mess. So I love these kind of markets. It's like, let everybody go crazy.
Yeah, that's awesome.
I'll leave the light on for you.
So are you in Georgia still? I know you've
I am. I'm in Atlanta.
Okay, cool. And is that your preferred? Do you like to invest in Georgia? Do you invest long distance?
Southeast. I would like to stay within an hour plane ride of Atlanta. I don't want to. I'm lazy. I don't feel like going too far out.
Yeah, well, the Southeast happens to be obviously an amazing market for demographics, et cetera. So, yes. Yeah, well, I'm excited to see, we definitely need to catch up when things start to change, if they do, when they do. I want to
double check. We'll do episode 2 and we'll see. Where was he then? And we'll do a recap and see, check. We'll double check my predictions. How's that?
Yeah, sure. Of course, you might be too busy for us to talk to you at that point, but
never too busy to talk real estate. No, and I love teaching. I love putting information out.
No, I just mean because you'll be doing so many deals, right? So.
Oh yeah, I'll do some deals. Yeah, that'd probably be the case. Yeah. No, but I love putting information and helping people out because I don't think there are enough people taking a realistic enough approach to discussing real estate at the moment. Most people are just rah, rah, rah about everything. And they usually have a sales pitch, sort of right after that. And other than my book, I'm not selling you anything. I'm just here to tell you the truth. I've got to buy out here myself. I've got to do business here. I'm not trying to mess up the market for myself. So I think the best competition is educated competition. Let me put it
Mhm.
like that.
Yeah, awesome. Well, you've delivered a ton of value, Bill.
Oh,
Thank you
appreciate
so
it.
much for coming on the show.
Sure.
Let's take a minute. Please share it with the listeners how to get a hold of you and anything else you'd like to share.
Absolutely. Yeah. Hey, feel free to reach out to me. I'm on all of the social platforms. My email is bill@gobroadwell.com. That's BROADWELL, Bill at Go Broadwell. You can go to broadwellpropertygroup.com if you're an investor and you want to find out about investing with my partners and I. Go to Broadwell Property Group. We've got a little investor spot up there. You can fill out your information. We'll be in touch shortly. My book is Creative Cash, and that's available on Amazon and Kindle. And creativeapartmentdeals.com. I have a masterclass on that website if you want to go download the masterclass, Creative Apartment Deals. But those are pretty much all the ways you can find me.
Awesome, Bill. Well, that sounds like a ton of great educational content that you have out there. I hope the listeners take some time, check it out. Thanks, Bill. Can't wait to
My
see you
pleasure.
on the other side. Take care.
All right. Take care. Thank you.